We're about to walk through a pretty brutal liquidation cascade. It happened fast, and it was incredibly precise. In less than 90 minutes, over $40 million in leveraged long positions just vanished. Now, this wasn't some slow bleed. This was a violent, forced selling event that put basically every portfolio on high alert as stop losses just got hammered across the board.
But here's the real kicker, the actual story of what happened. While all of that long side money was surgically removed, an even larger pool of short sellers sitting right above the market was left completely untouched. And the real question is, why? We're going to get to that. And hey, if you're already finding this valuable, do me a quick favor and drop a like and share.
So, to really understand the crash, we have to rewind and look at the minutes leading up to it. We need to see how the market built up this giant pool of liquidity that would very quickly become a target. This heat map here is basically showing you the fuel for the fire being stacked in real time. You see these bright yellow bands? That's tens of millions of dollars in leverage long positions all clustered together. This creates a giant pool of buy-side liquidity, and it acts like a magnet for the price.
And look, this wasn't random at all. The leverage was incredibly dense, packed right between $90,000 and $90,500. This created a super clearly defined zone, which, effectively painted a giant target on the market's back. We do these deep dives all the time, so if this is your thing, make sure you subscribe to the YouTube channel.
All right, now for the main event. This wasn't just a price drop. This was an active hunt for that exact liquidity pool we just identified.
And this shot right here just illustrates the cause and effect perfectly. On the left, at 1600 hours, you can see that dense yellow band of longs. Then on the right, just 2 hours later, it's gone, completely erased. Sellers pushed the price down into that zone, triggering the first wave of liquidations. Of course, that forced selling pushed the price down further, which triggered the next wave, and so on.
That chain reaction is what we call a liquidation cascade. It's a feedback loop where forced selling creates more forced selling, accelerating the whole price drop until the liquidity is just gone. It's one of the most powerful forces in these markets for sure. We often post about these events as they happen on Twitter, so you can follow us on there for more updates.
But the story doesn't end there, not even close. After the crash, the data revealed something completely counterintuitive. And, this is where the real edge is found. Just look at this. This is the market map after the dust settled. The area below is empty, those longs are gone. But now, look up here. A massive, bright yellow band of short liquidations is sitting just overhead, totally untouched by all that volatility.
The scale here is absolutely staggering. The leverage scale on the heat map now maxes out at nearly $47 million. That means this single cluster of shorts is even larger than the long positions that just got completely wiped out. And all this liquidity is concentrated right around $92,500. This is the new magnet. This is the next major target on the map. So this brings us right back to that core question. Why orchestrate a violent crash to take out all the longs, while just ignoring an even bigger prize just a few points higher? The bearish story everyone's telling just doesn't account for this. The data is suggesting the game isn't over. And if this analysis is helping you see the market a little more clearly, sharing it is honestly the best way you can support what we're doing.
Okay, so let's put all this together into a strategic takeaway. What does this all mean for the next move? Well, it looks like the market is now trapped between two extremes.
After a drop like this, the market sentiment is of course overwhelmingly bearish. But the objective on-chain data shows the complete opposite, a massive amount of bullish fuel sitting just overhead in the form of all those short positions. A potential short squeeze is now very much on the table.
So the key takeaway is pretty simple. Prepare for volatility. The market has shown its hand. It's now going to hunt liquidity at one of two extremes. Either it pushes down again to liquidate any new longs, or it reverses course to hunt that $47 million short cluster. The quiet period is over. So let's summarize. 1. The longs were targeted and cleared out. 2. A massive pool of shorts remains untouched right over our heads. And 3. This all means the market is primed for another high volatility move. The hunt is on. If you want to stay ahead of the next one, be sure to subscribe and drop a like below. Follow us on Twitter for more updates, and we'll see you in the next one.